The Australian property market is starting to exemplify the early signs of a $10 trillion housing market meltdown. After the decades-long increase in the price of housing, is the trend reverting? Stay until the end of the video as we will cover and go through the latest data as of August and July of 2022, and we will discuss the past, present and future of the Australian housing market. Hello friends and welcome to the Market Watcher, a place for gathering traditional financial and all other knowledge on a regular basis. According to the latest data stemming from the Australian Bureau of Statistics, during the summer months of 2022, the Australian housing market passed the $10 trillion mark. According to Statist.com, the expected GDP for 2022 is set at 1.75 trillion, so the total housing market is more than 5 times bigger than the total GDP, which is an incredible divergence and an anomaly. The information in the video lecture is provided via CoreLogic, one of the best Australian analytical firms. Let's start with some important facts. The total residential housing is sitting, as we said, at about $10 trillion. The commercial real estate is valued at about $1.2 trillion, and the total mortgages are $2.1 trillion. 57.3% of households' wealth is held in housing. This is why the property market and its dynamics are incredibly important. A slowdown or a downtrend in this sector directly makes the majority of the Australian population much poorer. National home values fell by 2% in the 3 months to July, which accelerated from a 0.2% fall in the June quarter. Most capital city markets are now in decline through the month of July. 5 of the 8 capital cities saw a decline in dwelling values, while growth rates slowed in the remaining 3 cities. The peak of the market on a yearly basis was set in January of 2022 when compared to January of 2021. Home values rose by 22.4%. A general rise in the housing of 22.4% is far and away out of norm, and after such a huge increase, the probabilities are that at some point the trend will go to the other direction. Economic and investment cycles are like a pendulum. The higher the disbalance on one direction, the higher the disbalance on the other direction will be. On the next graph, just to exemplify what I just said about the pendulum, the highest property increases during the last 2 or so decades are seen in Sydney and Melbourne, and these cities are seeing now the biggest price drops on average. The Sydney home values are down by 4.7%, while Melbourne is down by 3.2%. The graph is showing the last 3-month changes. But still, if we take a look at the data for a 12-month period, meaning from July of 2022 compared with July of 2021, the general increase is an average 8% for the whole of Australia, with some cities such as Adelaide and Brisbane seeing incredible 24.1 and 22.1% increases. The capital city Canberra rose by 12.1%, while the western city of Perth increased its home value by 5.5%. Melbourne is struggling to see some meaningful increases, and it's close to the negative territory for the 12-month period, with an increase of only 0.3%, while Sydney is experiencing anemic growth of 1.6%. On the next chart, which is showing specifically Sydney, we can see that in the beginning of 2022, Sydney experienced an annual growth rate of more than 25%, which is absolutely insane. Time will tell how low the current cooldown will go, but we will track the market and give updates when new and interesting data arises. So don't forget to subscribe to the channel so you won't miss out any of the upcoming content. From the peak of 2022 in January, home values are down by 5.2%. The situation in Melbourne is a bit toned down. The peak annual growth rates was again seen in January of this year, but the increases were of about 15%, with current home values being down by minus 3.4% since that peak price cycle. The third most well-known Australian city, Brisbane, had an average annual peak growth rate of about 30%, and still it has not experienced any significant drawdowns. Since that peak reached in January, prices are down by only 0.8%. Out of all major cities, Brisbane has had the highest average property increases in the early year of 2022. Interestingly, Perth and Adelaide currently are seeing record high prices, and never before have the values of homes been at such levels. While the city with the biggest price drop decline since its peak price is Darwin, which is down by minus 10.9%. In order to have a deeper understanding of the fundamentals behind the price rises or drops, we must know the changes in the median days on market statistics. For quite a long period, the median days a property was sitting on the market was around 50. Since the start of the pandemic, we reached a record low of only 20 days, which was set around November of 2021. Currently, the average for the whole of Australia is 32 days, while in July of 2021 the average was only 25 days. The longer the properties are sitting on the market, the lower the interest, and hence the closer we are to a market sentiment turnaround. Another thing which follows the increase of days on market is the so-called vendor discount. This is the average discount for property deals. During November of 2021, we saw the lowest level of discounts on property sales on average. The discount was less than 3%, which is incredibly low. The current vendor discount is about 3.8%, and it is steadily going higher. The highest discounts are seen in Sydney with an average of 4.8% discounts, while Hobart, Darwin, Adelaide and Melbourne are trailing in fairly close with all around a 4% discount. After our examination of the Australian home prices, we can conclude that the crash has not started, but the beginning of the cooldown period has. This cooldown is mainly due to the increase of the main interest rate of the Reserve Bank of Australia, which is the official name of the Central Bank of Australia. Since 2007, when the interest rate was 7.25%, we have seen more than a decade-long monetary easing. The lower this main interest rate, the more easily credit is obtained. And the more credit in a system, the higher the asset price values, and real estate is one of the first sectors which benefits from the economic policy of lower rates. As we see, the current level is 1.85%, which is much higher from the recent historical low of 0.10%. But still, a 1.85% level is a very low level. The higher the interest rate goes, the higher the credit repayments will be on the current debts. This leads to lower demand for housing and prices start to cool off. But the question is, why is the Central Bank of Australia doing something that destroys capital and brings investment and economic pain to its citizens? The answer is very straightforward, and it is doing so in order to stop the increase in the inflation levels. On the following chart, you see the spike in the Australian inflation level. Now we are sitting in close to a 20-year high with a level of 6.1%. And in order to firmly stop the price increases for all goods and services, the main interest rate needs to go above the inflation level, which currently is not possible without a massive tanking of all investment asset classes and specifically the housing market. To make a full property analysis, we must also comment on the rental situation in the country. July of 2022 has given us the 6th straight month of growth in the rent values, which is higher than the property growth of home values. On an annual basis, rents have increased by 9.8%, as we see on the chart. But Brisbane is leading the pack with a 12.7% increase, followed by Adelaide with a 11.3%, and the third place is going to Sydney with exactly a 10% rental increase. It is important to note that the rental increase of above or close to 10% are also abnormal rises and again are out of control. This makes it so that the average Australian is having harder and harder time just getting by with all prices of goods and services squeezing his pockets and leaving him close to a $0 disposable income for his wants. Almost all capital and income is allocated towards basic living. What is good for investors is the current higher growth in rents compared to home values. This drives rental yields higher, making the property investments more lucrative, but in general, a gross yield of below 5%, speaking in worldwide terms, is quite low. We will monitor the situation closely, and with this we end our video about the Australian housing market. Subscribe to the channel, like the video, and don't forget to leave a comment if you have some other ideas for new content. I read all the comments. Thanks for watching until the end, and I'll see you in the next video.